And for what today's news means for debt capital markets, we're joined now by Stephen Nash from FIIG Securities in Sydney. Stephen, welcome to you.
Helen, hi.
Now, are some of the recent ASX hybrid issues, are they very close to equity?
Look, in terms of our analysis, some of these securities are really designed for the issuer in the sense that they satisfy a lot of the requirements of the rating agencies. Some of them are quite complicated. The essential thing with debt in a lot of cases is that the terms and conditions don't allow the issuer to change these terms and conditions of the issue. So the payments, the repayment date are all fixed. A lot of these cases, those conditions are variable and allow the issuer a lot of wiggle room. A lot of these issues would probably not get any interest in the institutional market, and we feel that some of these issues could be quite difficult for investors to understand, and even though they're paying quite good spreads, it might be a little bit risky for a lot of investors.
Okay, so you wouldn't necessarily be saying they're kind of investor friendly, they are better for the issuers?
Basically, we feel it's in a lot of cases a better deal for the issuer. In a lot of cases when issues come to the ASX, it's much more expensive to do that rather than come into the OTC market. The OTC market also stops a lot of issuers from putting out terms and conditions which are of the nature that are coming on the ASX. So a lot of the institutions are very strict about these sort of things and probably wouldn't allow them to come on to that OTC market. So in a lot of ways the OTC market filters out deals that are possibly preferential to the issuer.
Okay, what about, equities? Do they have less excess return than perhaps previously thought?
Look, there's been a lot of discussion about this of late. Some commentators, including ourselves, have been pointing out that equities obviously have the highest return of the asset classes, but relative to debt, they have a lot more risk. So I think people are beginning to realise that equities have a good return, but they have to be really careful with the risk. So the idea is to combine a lot more fixed income exposure with equities to really cut that risk compared to what people typically have had. Typically people have had very high allocations to equities in the order of 75%, which really makes the whole portfolio really dominated by equity risk.
Yeah, so I just want to turn to some world issues now.
Yeah.
Do you think the hawks in the Fed in the US are kind of seeking publicity, in a sense, to push a barrow that's now a fringe Fed view?
Look, I think that some in the Fed are trying to resist the overall tendency towards more quantitative easing. I think that, yes, recently there's been some publicity gain from some of the hawks in the Fed. I think broadly the Fed's moving towards quantitative easing, and also I think...
so it is, sorry, and the market seems to be pricing in that it is, isn't it?
Well, it's been doing that for many months now. We've got the S&P very close to an all-time high, with the economy really not doing that well at all. The stock market has really got this built in very much. So the question is, what happens when they do it? And I would imagine what markets typically do is they buy the rumour and sell the fact. So there may be some volatility coming up, and that would coincide with the typical volatility we see in the September-October period.
All right. Do you think the US bond market is having a kind of a mini crash? And if so, why?
Well, it's been a very thin market so far, and as I've said, the equity market's been relentless in its rally. Some of the data has been a little bit firmer. We kicked it off with the payrolls being a little bit firmer, and some of the data, yes, has been a bit firmer, but you must expect some firming of the data given that rates have been quite low in the US and also oil prices have been low. What's happened of late, of course, is that rates have gone up and now oil prices are starting to head up as well. So we may see some lagged effects of those lower rates and lower oil prices coming through, but I think going forward those effects will be limited.
And of course that's before the sort of traditional tough time of September and October?
Just looking at the traditional measure of volatility in equities, the VIX index, typically much higher in those periods. We're in the run up to that right now. I think with the problems in Europe in the background all the time, also this expectation of quantitative easing in the market, we expect that volatility will increase and equity volatility will increase as well.
All right, we'll leave it there. Thanks so much for joining us, Stephen Nash from FIIG